Hello, my name is Katarzyna Dolatowska. I will present a short presentation regarding the implication of Marshall learning condition. What is a concept of currency devaluation? Basic concept is to increase export, which becomes cheaper, and decrease import due to its higher price. A higher level of export should lead to an improvement in the trade balance deficit. At the same time, import must decrease in domestic country. That can be achieved by substitution of more expensive foreign goods. A key here is the responsiveness of domestic customers to imported goods and foreign customers to exported goods. Then what increase country deficit? International exchange contracts signed before and the payments are collected after the currency devaluation, or when the export contracts are written in domestic currency and the import contracts are written in foreign currency. A developing economy, which relies on import of raw materials, may experience serious costs from a devaluation which makes basic goods and food more expensive. Less developed countries industrializing their economies fall into the trap of higher prices of imported materials needed by the manufacturing sector, especially if that sector is most significant in the trade balance. Higher decrease in value of export to import indicate that currency devaluation is not a cure for trade balance deficit. Currency depreciation will lead to improvements in the trade balance only when foreign customers are highly responsive to new cheaper export and domestic customers to more expensive import. Thank you.
The Dornbusch exchange rate overshooting model. Why exchange rate movements are relative. Exchange rates are more volatile than its supposed determinants such as money supply. The main features of this are that goods prices are assumed to be sticky. The asset prices have to move by more than the flexible price case in order for the markets to reach a temporary equilibrium. The main causes of exchange rate volatility. Any change in imports or exports change the rate of exchange. Capital movements from one country to another, exported or imported, will create a change in the rate of exchange. Stock exchange operations could be grant of loans, payment of interest, purchase and sale of foreign securities, which influences demand for foreign funds and then in turn foreign exchange. Speculative transactions could be seasonal changes in currency or even political uncertainty, which creates a scramble for some currencies, resulting in big fluctuations in exchange. The implications of this model: domestic interest rate is now lower than the foreign interest rates. The UIP uncovered interest rate parity condition is violated. Capital will continue reducing domestic money supply in the long run. There will be more volatility in exchange rate due to the overshooting and subsequent corrections that would otherwise be expected. Another implication of the Dornbusch overshooting model is that a currency can appreciate even if the interest rate of a country was lowered. That's because the currency did indeed depreciate first, but by too much.
This is a short presentation on purchasing power parity theory, or PPP. So what is PPP? PPP is a theory used to identify the relationship between product selling prices and foreign exchange rates. It uses the law of one price model, or the loop, which assumes that products sell for the same price regardless of their location in the world, and then relates this price to the exchange rates. For example, if an apple in the UK sells for £1 but then sells in the US for $2, then PPP would assume that the exchange rate would be £1 for every $2, or 1 to 2. So how useful is PPP in predicting future exchange rates? In the short run, it's not that great. It doesn't consider factors that would affect product prices. The biggest one is supply and demand of different countries. Supply and demand kind of meet in the middle for market value. PPP doesn't consider that, it takes it at face value. Other causes such as natural disasters and destruction of goods, or even poor harvests, would result in a price difference between the countries depending on what's happened. The opposite side of that, in the long run, it holds a bit better. It tends to be more consistent over time. Prices tend to revert back. In the little graph there between Japanese yen and US dollar, you can see there that the PPP line does fluctuate from the market value line, but the consistency is kind of there. They kind of revert back to the same trend. However, over a longer period of time, it still fails to acknowledge factors. Transactional costs are something that happen. They inflate the price, and PPP doesn't take that into consideration at all. Rich and poor divides between countries and cities are a big thing as well. For example, a bottle of water bought in London will be more expensive than one that was bought in Middlesbrough. Therefore, the bottle of water in London, the price that you pay for, is not representative of the true price of the product in the rest in the UK.
The next topic is the financial institutions' role and risk management in financial markets. During this crisis, the financial institutions and innovations can play the supportive and stabilizing role for the economy. For example, the Bank of England holds the interest rate at almost zero level, aiming to increase the lending and support businesses. The inflation rate is below 2%, which isn't so attractive for foreign investments. The pandemic accelerated the development of the financial technologies. The usage of facial recognition, digital payments, and the usage of digital money can support the online trading. Moreover, the implementation of blockchain technology in the supply chain can allow businesses to monitor and control deliveries in real time. The Internet of Things can help in predicting the demand in online trading. This pandemic can last long, and the companies should pay attention to the market behavior in the short run. According to the Dornbusch overshooting model, in the short run there can be significant increase in the exchange rates with following decrease in the long run. Hence, the most efficient strategy for the company in the long run will be to concentrate on the internal risk management techniques. But in the short run, the options contracts can hedge against foreign exchange rate. This topic is about the options and futures that can be useful to hedge against the foreign exchange risk. During the uncertainty in the financial markets, the companies prefer to use hedging tools such as currency options or futures contracts. Futures are binding contracts. There is no upfront premium. Instead, there is a margin account. Also, the holder cannot use the favorable movements in the forex exchange rates. Contracts are standardized, which means it's not possible to find exact match of size and date of the contracts, which leads to additional costs. But the contracts could be traded to offset the account. Moreover, in the case of the basis risk, the efficiency of the hedging could be decreased. Options are more flexible with no obligation to exercise. In the case of the depreciation, the loss can be limited by paid option premium, but the holder can use the favorable movements in the exchange rates. This pandemic caused huge issues within the supply chain and instability with demand, and risk of bankruptcy. It's not certain if the company will receive money. Hence, in the short run,